It's a common assumption, isn't it, that when a mining or oil and gas company sinks millions into exploration and comes up empty, those costs are just, well, an immediate write-off.
Yeah, people often think that.
But the financial reality of how these companies account for their initial ventures beneath the surface is actually far more intricate. Today, you're joining us for a deep dive into IFRS 6.
That's the International Financial Reporting Standards specifically for the exploration for and evaluation of mineral resources.
Exactly.
Think of IFRS 6 as the um, specialized accounting framework. It governs how companies in the extractive sector, oil giants, smaller mining firms, handle these significant spending and potential assets tied to those very first steps.
Right, the searching for and assessing potential underground resources, be it minerals, oil, natural gas.
Exactly that.
And for you, the learner, why does this matter? Well, this isn't just about some obscure accounting rule. Understanding IFRS 6 gives you a crucial window into the financial core of a massive global industry. It shows how they figure out what might become a valuable asset when facing immense uncertainty. It's high-stakes, high-reward stuff, right? Reflected directly in their financial reports.
We're basically getting a behind-the-scenes look at how value is assessed in some pretty unpredictable business environments.
So our mission in this deep dive is to pull out the key insights from IFRS 6 for you. We've looked at the standard itself, interpretations, practical guides.
Yeah, to bring you a clear, digestible understanding. We'll focus on what counts as exploration and evaluation spending, how those costs are treated financially, and critically, when these initial assets get reevaluated or potentially written down.
Okay, so let's get into the nuts and bolts. What exactly falls under the umbrella of IFRS 6?
Okay, so the standard has a very specific focus. It applies to the spending a company incurs during the exploration and evaluation phase of mineral resources.
So the initial activities to locate and assess potential deposits, basically. Minerals, oil, gas.
Right, that specific window.
Yeah, and just as crucial, what are the limits? What costs from the very beginning are not covered by IFRS 6?
That's a really important distinction. IFRS 6 doesn't apply to costs incurred before a company gets the legal right to explore a specific area.
Ah, so before you even have the permit.
Exactly. Those pre-license costs actually fall under a different standard, IAS 38, which deals with intangible assets. So before you have permission, different rules apply.
Right, so the accounting's different before you can even start digging. What about costs after they've found something promising and are moving towards extraction?
Good question. Once the technical feasibility and commercial viability of actually getting the resource out are demonstrable, IFRS 6 stops applying.
Okay.
At that point, the spending is considered part of development and production, and those phases fall under other IFRS standards like IAS 16 for property, plant, and equipment, and again, IAS 38 for development-related intangibles.
So there's a clear handoff point.
Yes, and the IFRS Interpretations Committee clarified this back in 2006. The scope of IFRS 6 is strictly limited to that initial E&E phase, exploration and evaluation.
It sounds like the extractives industry operates under slightly different financial rules during this initial phase, maybe reflecting the risks involved.
That's a sharp observation.
Yeah.
During this E&E phase, there are specific exclusions from certain other IFRSs that apply uniquely here.
Like what?
Well, for instance, IAS 2 on inventories has special rules for mineral producers valuing stock. And while IAS 16 covers the equipment used, it doesn't dictate how the E&E assets themselves are recognized.
Okay.
IFRS 16 on leases also excludes leases to explore for these resources, though it covers leases for equipment used in exploring.
Interesting distinction.
And as we mentioned, IAS 38 excludes development and extraction costs. Even IAS 40 on investment property excludes mineral rights and reserves. It all just emphasizes the unique accounting landscape for this initial uncertain period.
Okay, let's circle back to those pre-license costs. Our sources flag this as question 1, and it seems pretty clear. They're outside IFRS 6, fall under IFRS 38.
Precisely. Because they happen before the legal right to explore is obtained, they just don't meet the criteria for IFRS 6.
But what about the costs directly tied to acquiring those legal rights? Question 2 asks if those can be capitalized.
Yes, they can be capitalized under IFRS 6, but only if the company has a policy to capitalize E&E expenditure.
Ah, so it depends on their chosen policy.
Right. Since these costs are directly linked to getting the permissions that allow activities within IFRS 6's scope, they're seen as part of that initial phase.
Yeah.
You need the right to explore for IFRS 6 to kick in for those costs.
That makes sense. You need the ticket to get in the game. Now, what about the cost of an option to acquire those legal rights? That's question 3, and it sounds a bit more nuanced.
It is. The cost of buying the option itself isn't initially within IFRS 6, again, because it's before you have the full right to explore. But the critical factor is whether that option actually lets the company carry out exploration and evaluation activities.
Ah, so if the option gives you permission to start looking around.
Exactly. If it does, then the cost of that option can be capitalized as part of an E&E asset.
And if it doesn't, if it's just an option to get the rights later.
Then it's treated as a separate asset under other IFRSs. It might need impairment testing under IAS 36, or could even be an IFRS 9 financial instrument.
Okay.
But importantly, if the company does eventually exercise that option and gets the full legal right, the carrying amount of the option at that point gets rolled into the cost of the acquired right.
Okay, that clarifies the initial boundaries of IFRS 6 pretty well. Now let's delve into how these E&E assets are actually recognized and measured. The standard says initially measured at cost. Sounds simple, but what costs are we actually talking about?
Well, at cost is the starting point, but the standard gives significant flexibility in deciding which expenditures get recognized as E&E assets.
Flexibility. How so?
The basic idea is the extent to which the spending can be directly linked to finding specific mineral resources. And crucially, once a company sets its policy on this, they have to apply it consistently.
So within some broad lines, it's up to the company to define what's directly linked to the search.
Pretty much. IFRS 6 gives a list of examples, non-exhaustive, mind you, of what might be included.
Like?
Acquiring those exploration rights we just discussed, costs of topographical, geological, geochemical, geophysical studies, basically all the initial science work.
Okay.
Also, exploratory drilling, trenching, sampling, and activities, looking at the technical feasibility and commercial viability of extracting anything found.
That covers a lot of the early groundwork. But what about the costs of actually setting up a mine or drilling, producing wells once something's found?
Right, those development expenditures are explicitly not E&E assets. As we touched on, the conceptual framework and IAS 38 guide the recognition of assets from development activities. That happens after the E&E phase, once viability is proven.
Right, that key dividing line. Demonstrable technical feasibility and commercial viability. What about cleanup costs? The costs of restoring a site after exploration, even if nothing's found.
Good point. IFRS 6 does cover obligations for removal and restoration. If these obligations pop up because of E&E activities, they're recognized under IAS 27, which deals with provisions.
Okay.
And how you account for the other side of that entry, the debit, depends on how the related exploration spending was treated. If the exploration cost was capitalized, the restoration obligation cost is also capitalized.
And if the exploration cost was expensed?
Then the restoration cost is also expensed. Interestingly, any changes later on in the estimated cost of that restoration provision, they hit profit or loss immediately.
So even if a project yields nothing, the future cleanup costs are still accounted for. Now, you mentioned flexibility in policy. Our sources highlight a temporary exemption from parts of IAS 8. What's the significance of that?
This is a really key point. When a company develops its accounting policies for E&E assets, IFRS 6 gives a temporary break from paragraphs 11 and 12 of IAS 8.
And what do those paragraphs normally do?
Normally, IAS 8 sets out a strict hierarchy of sources an entity must look at when no specific IFRS directly covers something. This exemption essentially gives companies more leeway in deciding which E&E expenditures can be capitalized.
Even if they might not strictly meet the definition of an asset in the conceptual framework.
Exactly. It acknowledges the unique challenges and, frankly, the huge uncertainties in this early stage.
Okay, here's where it gets really interesting. So, they can basically capitalize costs that, under normal rules, might have to be expensed straight away, like research costs.
That's the practical outcome, yes. Companies can capitalize E&E spending that, if looked at strictly under IAS 38, might be seen as research costs and would normally be expensed as incurred.
Wow. And does this affect impairment too?
It can. It potentially leads to a delay in recognizing impairment losses compared to standard IFRS. This is because E&E assets are only formally assessed for impairment when specific facts and circumstances suggest it's needed or when they're reclassified to development.
So no automatic annual impairment tests during the E&E phase?
Not necessarily a full quantitative test based on cash flows, no. The triggers are different.
That explains why our sources mentioned potentially delayed impairment recognition. Okay, let's tackle some more of these FAQs. Question 4. Dry well costs. If a company sees a whole exploration area as one asset, can they capitalize the cost of a well that turns out empty?
Yes, they can. If the company views the whole area as a single asset, the cost of that dry well is seen as adding to the overall geological understanding of the area.
Even though that well was a dud.
Right. The information gained is still valuable for making decisions about the rest of the area, so it can be capitalized as part of the cost of that bigger E&E asset.
Okay, so it's about the wider knowledge gain, not just the success or failure of one hole. Question 5 asks us about similar spending, but with different chances of success, like drilling in different countries with varying geology. Do those need different accounting based on probability?
Generally, no. The fact that the same activity, say exploratory drilling, has different success probabilities in different places doesn't mean you have to split the expenditure based on those odds. It would typically be treated as one type of E&E expenditure.
That keeps things simpler, I suppose. Now, question 6 is about finance costs, interest on loans for exploration. Can those be capitalized as part of the E&E asset?
Yeah. The link between IAS 23 on borrowing costs and IFRS 6 is, well, a bit murky
Ways not.
because the inherent uncertainty about future economic benefits in the E&E phase. IAS 23 usually requires capitalizing borrowing costs directly linked to acquiring a qualifying asset, but only when it's probable those costs will lead to future economic benefits.
And in exploration, that probability is hard to nail down.
Exactly. Given how speculative it is, determining the probability is tough. Our sources suggest that while expensing borrowing costs is defensible.
Okay.
You could also argue that the temporary IAS 8 exemption in IFRS 6 gives the flexibility to capitalize them if the company thinks it fits their overall E&E accounting policy.
So no single right answer in the standard. It depends on their policy choice.
Pretty much. It often comes down to the company's specific, consistently applied policy.
It really sounds like IFRS 6 builds in room for judgment, acknowledging the unique uncertainties here. Now, question 9 in our sources goes into the different approaches companies can use if they do choose to capitalize E&E spending. What are some common methods?
Right. Historically, you see several main methods in the industry. The big ones are successful efforts, area of interest, full cost, and partial capitalization.
Okay, let's quickly break those down. Successful efforts. What's the idea there?
Under successful efforts, generally only costs directly tied to discovering, acquiring, or developing specific commercially viable reserves get capitalized.
And unsuccessful costs.
Typically expensed immediately when they're deemed unsuccessful. Although there can be nuances, like sometimes capitalizing unsuccessful development wells if the whole area is seen as one cost center. It's a more conservative approach overall.
Okay, linking capital costs directly to proven reserves. What about area of interest? Sounds broader.
It is. An area of interest is usually a geographical zone deemed geologically promising. Under this method, all E&E spending within that area gets capitalized,
On what basis?
on the expectation that those costs will be recovered, either through successful development within the area or by eventually selling the area itself. It's a bit more optimistic, capitalizing across a wider potential zone.
Then there's full cost. That sounds like it sweeps everything in.
It does can too. Full cost involves capitalizing almost all costs: prospecting, acquiring rights, exploration, appraisal, development, construction within large cost centers, often like entire countries.
But does that fully align with IFRS?
Our sources point out some potential conflicts, things like capitalizing pre-license costs, maybe not clearly distinguishing intangible assets at a detailed level, and potential issues with impairment testing when moving to development. So while it's a historical practice, it needs careful handling under IFRS.
Okay, so full cost needs care. What about partial capitalization?
As the name implies, this involves capitalizing only certain defined types of eligible costs while expensing others.
Like,
A common example in some places is capitalizing the initial cost of acquiring a mining asset, but expensing all the later exploration costs. It's more selective about what becomes an asset early on.
it's really striking how much variation IFRS 6 seems to permit. It really highlights that global consistency here is a challenge.
It absolutely is. That flexibility within IFRS 6 plus the different historical practices under various national standards means there's quite a bit of inconsistency globally in E&E accounting.
Do certain types of companies favor certain methods?
Larger companies, especially those with U.S. GAAP influence, often lean towards successful efforts.
Yeah.
But the choice can really impact reported profits in the early stages.
Yeah, I can see that. Okay,
Yeah.
switching gears to presentation. Once these E&E assets are on the balance sheet, how are they classified? Tangible, intangible.
IFRS 6 says they're classified as either tangible or intangible based on their specific nature, and you have to be consistent with similar assets.
For example.
Drilling rights would usually be intangible. Physical things like vehicles, drilling rigs used in exploration, those are tangible.
Seems logical, but what if a tangible asset, like a specialized rig, is used to develop an intangible asset, like gathering geological data for drilling rights? Does the rig become intangible then?
No, the standard's clear on that. While the depreciation of a tangible asset used to develop an intangible asset becomes part of the cost of that intangible
That's
asset,
right.
the tangible asset itself stays tangible. Its classification doesn't change.
Got it. Tangible stays tangible. Now, let's talk impairment, a critical piece. When do these E&E assets need checking to see if their value has dropped?
The general rule is assess E&E assets for impairment when facts and circumstances suggest the carrying amount might exceed the recoverable amount. This lines up with the main ideas in IAS 36 on impairment.
But I understand IFRS 6 brings in some specific indicators for this industry.
Yes, it does. Paragraph 20 of IFRS 6 gives a list, again, not exhaustive, of specific triggers for an impairment test for E&E assets.
And these are tailored for the sector.
Exactly. They're designed for the unique risks here. And for these specific assets, they effectively replace the more general impairment triggers you find in IAS 36 paragraphs 8 to 17.
Can you give us some examples of these specific triggers?
Sure. Things like the legal right to explore in an area expires with no expectation of renewal, or there's no budget or plan for significant further E&E spending in that specific area.
Okay, what else?
If exploration hasn't found commercially viable resources and the company decides to stop activities there, or if enough data emerges showing the carrying amount is unlikely to be fully recovered, even if development eventually happens.
These all sound like pretty major negative signs about future benefit. Why were these industry-specific indicators needed on top of the standard IAS 36 ones?
The main reason is that during early E&E phases, these assets often generate zero cash flow. And there usually isn't enough reliable info about the potential resources to accurately estimate their recoverable amount using standard IAS 36 methods, which rely on things like fair value less cost to sell or value and use calculations based on future cash flows.
So applying the normal triggers might be too harsh, too early.
Potentially, yes. It could lead to writing off potentially valuable exploration assets prematurely. So these specific indicators focus more on fundamental shifts in the project status and the company's plans.
Makes sense. Do other things still trigger impairment, like falling commodity prices?
Oh, yes. Other events like significant drops in commodity prices or major adverse regulatory changes can definitely still trigger an impairment test under the broader IAS 36 principles.
Right. So you look for the IFRS 6 specific triggers first, but other major events count too. Our sources have an example: failed test wells. Scenario 1 asks if the first 5 wells failing automatically triggers impairment. What's the answer there?
Well, if the company views the whole exploration area as a single asset, and crucially still plans to continue exploration in that area,
Okay.
then the failure of those initial wells doesn't automatically trigger impairment. The geological info gained, even from dry holes, still adds to the overall understanding of the entire license area's potential.
So the costs can stay capitalized.
Yes, the costs tied to those wells can continue to be carried forward as part of the E&E asset for the whole area.
So it's the assessment of the overall area's potential and the company's continued commitment that are key, not just individual results. Now, what happens when an E&E asset does successfully move out of this initial phase into development?
Good point. When an E&E asset gets reclassified as a development asset, because technical feasibility and commercial viability are now demonstrated, paragraph 17 of IFRS 6 requires an impairment test before that reclassification happens.
A checkpoint before it moves on.
Exactly. It ensures the asset's carrying value is still supportable before it enters the next stage.
And at what level is this impairment assessment done? A single well? A whole field? A region?
IFRS 6 allows some flexibility. The test can be done as a level of one or more cash-generating units, or CGUs.
But is there a limit to how broadly you can group things?
Yes, there's an upper limit. The level used for impairment testing cannot be larger than an operating segment, based on how the entity reports internally and externally.
Okay, so it has to be reasonably granular, tied to how the business is managed.
That's right. Ensures the test reflects economic reality at a sensible level.
Okay, so aggregation is possible, but capped at the segment level. Now, what if a company wants to change its accounting policy for E&E spending? Is that allowed under IFRS?
Yes, but with important conditions. A change in accounting policy for E&E is allowed only if the change makes the financial statements more relevant and no less reliable, or vice versa, more reliable and no less relevant.
Yeah.
And if the change brings the company's policies closer to meeting the criteria in IAS 8.
How does that initial temporary exemption, the one letting them deviate slightly from the conceptual framework's asset definition, play into subsequent changes?
Right. That initial exemption gives more flexibility when first setting the policy. But any later changes have to show a move towards IFRS principles.
So what kind of changes might be acceptable?
For example, changing from capitalizing all eligible costs to a more conservative, successful efforts basis, or even to expensing everything, would likely be okay. It's often hard to prove early-stage exploration costs definitively meet the strict asset definition anyway.
What about going the other way, from successful efforts to capitalizing more?
That might also be justifiable, but the company would really need to clearly show that the change results in more relevant and reliable financial statements. Any change needs solid justification under IAS 8.
So changes are possible, but need good reason and must improve the financial reporting quality. Finally, let's talk disclosures. What specific info do companies have to reveal about their E&E activities?
The main goal is transparency. They need to disclose information that clearly identifies and explains the amounts in the financial statements that come from E&D activities.
What does that mean in practice?
Specifically, they have to disclose their accounting policies for E&E's spending, including how they decide what gets recognized as an asset.
Okay. And the numbers.
Yes, they need to disclose the amounts of assets, liabilities, income, expense, and the operating and investing cash flows that are specifically from their E&E activities. This gives investors visibility into the financial impact of these risky ventures.
So clarity on their accounting choices and the resulting financial impact is key.
Absolutely. E&E assets are treated as a separate asset class, and the specific disclosures needed by IAS 16 for tangible or IAS 38 for intangible assets have to be made, consistent with how the E&E assets were classified.
Any other relevant disclosures?
Definitely. Given all the uncertainties and judgments involved, IAS 1.122, which requires disclosing significant management judgments, and IAS 1.125, covering assumptions and estimation uncertainties, are highly likely to require more disclosures related to E&E.
That makes sense.
Oh, and our sources also briefly mention Australia. While they have reduced disclosure requirements, RDR, for some entities, the specific disclosure rules under Tier 2 for ASB 6, the Aussie version of IFRS 6, are actually identical to Tier 1. So no break on E&E disclosures there.
Okay, good to know. Now, our sources also briefly mention farm-in arrangements. What are those exactly, and how does IFRS 6 fit in?
Right, a farm-in is pretty common. It's where an entity already holding an E&E interest, the farmer agrees to give up some of its rights or future reserves to another party, the farmee,
In exchange for what?
in exchange for the farmee funding certain E&E obligations. It lets the farmer share the cost and risk, while maybe keeping a piece of any future discovery.
Does IFRS 6 specifically cover farm-ins?
Not explicitly, no, but the generally accepted view is that its principles do apply, because the farmee is doing E&E activities that fall within the standard scope,
Okay.
and the farmer is essentially disposing of part of an E&E asset.
So how do farmers usually account for these deals?
Typically, the farmer doesn't record any spending that the farmee pays for on its behalf. Also, the farmer usually doesn't recognize a gain or loss on partially disposing of a capitalized E&E asset.
What happens to any cash received from the farmie then?
If the cash isn't specifically meant to fund the farmer's own future exploration spending, it's just credited against the carrying amount of the farmer's existing E&E asset.
And if the cash received is more than the carrying amount of the asset portion given up?
Then that excess amount is recognized as a gain in profit or loss. Our sources give a couple of examples illustrating this. It's basically a way companies manage the high costs and risks.
It sounds like a practical way to share the financial burden and potential upside in this capital-intensive, uncertain industry.
Exactly.
Yeah.
It facilitates exploration that might not otherwise happen.
So bringing it all together then, IFRS 6 is this specialized accounting standard really tailored for the unique world of mineral and oil and gas exploration and evaluation. It focuses on that initial higher-risk phase, gives some flexibility in capitalizing costs because of all the uncertainty.
Right, that's key.
Has its own specific triggers for impairment testing, and demands detailed disclosures for transparency.
That's a great summary. And a really interesting point to remember is that temporary exemption from parts of IAS 8, it really shows the accounting world grappling with how to recognize assets in these super early stage uncertain activities.
And for you, the learner, we hope this deep dive has shed some light on the financial foundations of an industry critical to our global economy. Understanding IFRS 6 gives you a framework for analyzing the financial risks and potential rewards tied to finding the resources that power our world. It definitely makes you think about how these accounting choices might sway investment decisions and how investors judge the health and future of these companies.
And that raises a really important question for you to think about. How might those different permitted accounting policies, say, conservative successful efforts versus broader area of interest, actually change how investors perceive a company's financial stability and growth potential, especially in such a volatile sector?
That's a crucial thing to consider when looking at these companies, absolutely. And while IFRS 6 is the current rulebook, the ongoing debates about the best way to account for these uncertain beginnings suggest this field will probably keep evolving, right, as the industry changes.
Indeed. The search for resources never stands still, and it looks like the accounting for that search won't either.